Hey everybody, so we've got a new format for our show. In fact, it's now a podcast instead of a live cast, but you're going to get the same hijinks and information and market intelligence from your two hosts, co-hosts. But now we changed the name of the show to the Laffer Tengler Take instead of the MMM. But we're moving on, and it's part of a whole new rebranding of the firm's website and all the stuff which is coming, so we're really excited about that. But we're going to have the same type of content, just a little bit better format, and hopefully a little bit more punchy and sharp. I think is what the marketing guy said, sharp. Not my witch.
Be honest, though, Arthur. We had to go to a podcast format so we could edit out all your profanity.
Yeah, that's the truth. We got a couple of threats of lawsuits.
Not true.
Okay. Out half a program really doesn't add value.
So you're going to, tell us about, well, first of all, I want to say that Arthur runs our dynamic inflation strategy. So he's quite an expert, and it's dynamic, which means you can own it even when inflation has come back down. And it's done amazing this year, even though we've seen a rescindance, or what's the word I want, of inflation. So I hope that you're going to talk to us about that and maybe give us a little insight into what you're thinking about gold, and then we'll go from there.
Yeah, thank you, Nancy. That's very nice. That was a good plug. So I think one of the boring topics, it's like, it's funny, the gag I do when I've done speeches for groups and I say I'm going to talk about the economy. And so my tchotchkes, my gifts, usually people have wholesalers or stuff, they have these gifts, golf balls and stuff. I hand out Valium and barf bags because economics, they call it the dismal science for very good reasons. So I'm going to start off with that, setting the bar really high for the introduction. And I think one of the things that's really interesting, that you should never get into these topics unless this is what you do for a living. Never talk about religion, or never talked about how sausage is made. Never talk about what goes into CPI or any of these other crazy macro numbers you get from the BEA or BLS. For even an advanced practitioner of these sports, of these arts, but they're more akin to throwing out bones and trying to vying the spirits. But looking into like CPI and how many different levels and layers there are, and people get so caught up, Nancy, in really minute changes in CPI, and look at core, and we talk about PCE, which is basically like a derivative of the consumer price index. And what I caution people all the time about is like, hey, some of these numbers, they tell you really two things: direction and magnitude. They tell you which way the series is moving, and they tell you how fast or how much it's moving. But they're not, a lot of these series, they're not spot accurate. The data collection is something like CPI. It literally will make your head hurt. How much they collect, how much they don't collect, where they get the prices from, who they're trying to tell you that the CPI actually corresponds to. So it's all these averages and estimates. So with that being the case, CPI is really what the consumer price index, or we call it CPI-U, which is the all index, is kind of our best measurement of general inflation levels, which is your lack of purchasing power per dollar. That's really what we call about inflation. So what I thought I'd do is, thank you.
Lack of purchasing power.
Yeah, that's what it is. It's actually the real classical definition of inflation is your purchasing power per dollar, or per monetary unit. So if you're in France, it's the euro. If you're in the US, it's the dollar. So wherever you are, it's how much your money buys now versus before and into the future. So if it buys less, then basically you're suffering from higher inflation. And by the way, deflation is mild deflation's just like mild inflation. It's not a big deal. Big deflation, which we had it actually post-U.S. Civil War. And what happens is all these basic Confederate dollars came out of circulation. They were worth nothing. And so you had a huge demand for dollars and a really low supply. So the value of each dollar went through the roof with massive deflation. Not good either. So anyway, I thought good history lesson. I've used this chart in the past, and this is the history of CPI, the Consumer Price Index. And this is an annual number. So what we're looking at here, and I've color-coded it, and basically these are the general levels that the Fed uses to really classify, generally speaking, classify where inflation is. So anything between 0 and 1.5, the Federal Reserve and most can say that's no real inflation. The Fed targets somewhere between 1.5 to 2.5%. That'd be a kind of a normal inflation environment. Moderates between 2.5 and 4. High inflation is 4 to 6, and then very high is everything above 6. We even have hyperinflation. We haven't seen that in a long time, at least nothing close in the U.S. But that was like, these massive devaluations, and like Argentina had it, Mexico's had it, most of Central South America, Asia. Look, post-World War II, Japan and Germany, the Weimar Republic, when they were coming in wheelbarrows of money to buy loaves of bread. Zimbabwe, the 17 gazillion dollar bill, whatever it is, and worth 3 cents. So this is U.S. history from 1970 to 2024. These are annual CPI numbers, and I color-coded them to correspond with my table. So you see the 1970s, that was the last time before this recent period where we had really high inflation. Came off the dollar, the gold standard, officially under Nixon, and we had this huge inflation. And then it slowed down. Paul Volcker nipped it in the bud. And you can see we had a little bout of it in the late 80s, early 90s. And then pretty much it's been benign from basically 92 on until we had the most recent event. And you can see it pops back up into the red, although it's still lower than what we had back in the 70s. And one of the topics that, Nancy, we've talked about is gold's run lately. Right.
Yeah,
and
yeah.
so one of the discussions is, well, if you think inflation's a problem, what you do is you buy gold, right? Or you try to buy something that's a gold that's an inflation hedge. And so what I wanted to talk about in the next slide is the history of gold.
You and I have also talked about how unreliable the numbers are, how somewhat arbitrary. And if you are aware, as most people are, that the Bureau of Labor Statistics was calculating the jobs numbers, and then they've had to revise them down. So this would be new jobs. They've had to revise them down 1.7 million in the last 2 years, which has profound implications for productivity. It means productivity is better, which we're going to talk about later. But they also calculate CPI. And in February of this year, right when Trump took office, they were imputing 9%. Remember, we've talked about this, 9% of the prices. What does that mean? Well, if they couldn't find a price in a particular region, they would use a price from another region. So 9% of the input numbers were estimates, to be polite. The next month, it went up to 32%. And I think it's actually been growing. But so we have 1/3 of the numbers being guessed, basically, or estimated or imputed, however you want to say it. They're not real solid numbers. And so when these numbers come out and Wall Street reacts to them, it's really a ridiculous response to respond at all. So anyway, I just wanted to put that in there because you've brought it up. We've talked about it. And I think it's important to go to this, to the reliability of the numbers as well.
Yeah, and it's even worse than that, by the way. I mean, some series aren't calculated monthly. Like a lot of times, like rents don't typically change a lot. So in fact, you and I were talking earlier about the two series that I like to look at, which is sticky inflation and flexible inflation. So it's CPI, and they break it out into price behavior. So there's some series that they collect where they don't collect them every month because they typically don't change a lot. So you're not even seeing monthly actual changes for some of these series. Other ones, the sample sizes are very different than others. And then remember, there's the whole basket. So how they determine what goes into the CPI number, what items. And it includes services, and it includes some taxes, but not other taxes. Like in the fuel prices, taxes are already imputed in the price. Like when you go to the pump, it includes the price.
Right.
But if you go buy an apple, it doesn't. You have to wait till you get to the register. So some actually have sales prices in them, some don't.
Yeah, it's nuts.
Case in point, it's a messy. All these numbers, for the most part, are pretty messy.
Yeah. Okay, sorry to interrupt. Go ahead.
No. So what I did is, a long time ago is I looked at whether gold was really a good place to kind of hang out if you thought inflation was coming. I've always been taught that really gold is telling you typically two things. It is telling you sometimes that inflation's coming, and it sometimes can be a good hedge but it's also an indication a lot of times of fear, and it's also supply and demand related too. So there's not just one thing that gold responds to, and that's the point of this next chart here. So the colors actually correspond back to the CPI numbers. They're not the actual returns of gold. The bar itself is the return of gold. So for example, if you look back in 1979, you see gold was up 133.4% that year. That's for the whole calendar year. And that was a very high inflation year. So the red means it was very high inflation and gold ran through the roof, right? But you look at 1975 when inflation was still raging in the 70s and gold was down 25% that year.
Wow.
In fact, in 81, Nancy, gold inflation is still raging and gold's down 32%. So, and then you look at this whole period from 92 to before now, and gold, like some years is up, some years is down, some years is up a lot, some years is down a bunch. The point being, the correlation isn't that strong historically to owning gold and inflation.
That's a headline, Arthur. That's a headline.
Yeah. But look at what happened these last 2 years when we had inflation really pop back up. Gold was negative. Gold was down. The spot price of gold was down for those 2 years. And now it's rallying, which is really interesting.
Why? Why is it rallying?
These are really hard things to figure out sometimes because you don't really know what the actors that are driving the price up. I think there's a lot of central bank activity from what I can tell. I think the trade and the tariff issues is actually causing issues with gold in particular because a lot of these prices really started to move middle of this year. It's not just gold, it's silver and platinum and palladium. And platinum is really just, for the most part, used in jewelry and stuff. Platinum used to be used catalytic converters. We don't do that really much anymore. Palladium also, and not other metals. So it's really just the precious ones that really took off. And it's funny that it coincides right around the middle part of the year of this year when they really started to move. So I think it's a way of getting around sanctions and tariff issues, and it's a means of exchange rather than trying to use dollars.
And just for everyone that's watching, we produce a research bulletin where we track the movement and the year-to-date performance of all the important metals, among other things. So Arthur's absolutely right. And if you're not getting it, you should reach out to someone at the firm. Dini Butkevich is probably the best. And we'll get you on the distribution because we talk about all sorts of things in there. But yeah, that's super fascinating.
Yeah, so I'm done talking about this chart. I just really wanted to say, people think you can just go and own gold during inflation times. And sometimes it works, sometimes it doesn't. Gold has a lot of different factors. And so you have to be really thoughtful about investing this way, just like you do any other type of investing, whether it's, see what you do with the equity income and equity growth and all the strategies you run, as well as people that do bonds and stuff too. So it's a science. It's not all art or science. It's kind of a combination, but one size does not fit all. Great topics. A lot of fun. Everybody's asleep now.
Well, what do you want to wake them up with? Do you want to talk about jobs? You want to talk about AI bubble?
I think we should talk about jobs because I think it actually really lends itself to the AI discussion that we've been having lately, especially that you've been really talking about with regard to AI in companies and what they're doing and the money, and how this whole, is there an AI bubble? Are we about to have a huge correction? Are we going to have a bear market? I'm hearing that.
Yeah. I just got quoted in Axios saying that the people talking about the bubble are the people that got out in April and forgot to get back in for the next 25% rally. So we can talk about that. But you directed me to a really good article, which reinforces what we've been saying as a firm. And that is that while jobs may be weaker than what we thought, and it seems they are, the supply has gone down, right? And so the unemployment rate has stayed pretty healthy between 4 and 4.3%. And we've attributed that to AI. But I would love your thoughts on, what the job numbers mean. Now that we're not getting them, the government shut down. Again, it's BLS, not very reliable. One of the reporters that interviewed me said she talked to the Fed governor in charge of San Francisco area. And she said, it's okay that we don't have government numbers. I'm just using private sector numbers from The Economist. So Apollo and Goldman and those firms. So I don't know. Talk about a dismal science. If the Fed isn't using real numbers, how do they set rates? But that's a topic for another time. But so what do you think? What do you think about the jobs situation?
Yeah, I think that what's interesting is people have a tendency, I do too, I think everybody does, is, you have rules of thumb, right? And so you kind of look at past patterns to kind of give you an indication or to set up a view of how things should be. And when something changes in that scenario, like, what does that mean? That's great until you hit a paradigm shift. And I think with the election of this new administration, we had the Obama bill that was passed. So that continued the tax cuts under Trump's first term, which is really good, I think, for the economy, consistency, and also, but there's some really good stuff, Maisie, that you just wrote about in the research bulletin about 100% expensing, which is a big deal. This is good for corporate America. It's good for low-wage workers, too, the no tax on tips. I mean, this is really good for the working man, but also really advantageous from a tax standpoint for corporate America. But what's interesting is that you're right. Like, we're basically deporting a whole bunch of people, and people are actually self-deporting now. The numbers look like around 2.5 million people have left the country since this stuff started. And the second thing is AI is coming in and really driving productivity gains, and that's going to get bigger, not smaller. I don't see any way this doesn't. Forget about the data centers and building nuclear plants to power Microsoft, whatever AI or X, whatever what they're doing. We're just talking about moving into the regular economy.
Yeah.
Replacing and making labor much more productive.
Yeah. And I actually saw a chart that was fascinating to me because it shows that overall unemployment hasn't really increased. But in the industries where AI is being embraced, it's gone up dramatically. So it's super small, but like architecture and engineering services, computers and math, programming, business and finance. So that the layoffs, and we've seen that, like Goldman Sachs saying, we don't have to hire entry-level employees anymore. We'll have AI write the IPO offering circulars up to a point, and then we'll have a manager review them. So I think we're going to continue to see that, but you're right. I mean, it's a combination of AI and then the tax bill, the One Big Beautiful Bill Act, which I think they're changing the name of, that has a lot of benefits. I think the average U.S. taxpayer, or not the average, but U.S. taxpayers in general are going to receive $158 billion more in tax refunds, it's estimated in February, for a grand total of $512 billion. So most of those people live paycheck to paycheck, and so they spend it. And I think that's going to be very powerful for the economy. Not a lot of people are talking about that. They're more worried about the fact that NVIDIA is investing in Intel and AMD or OpenAI is investing in AMD. And there's this circular movement, which happened in the 90s. But in the 90s, they were doing it with debt. Today, they're doing it with cash on the balance sheet, cash flow. I mean, there's a few debt issuances, but in general, I think that's a pretty powerful comment. But can I just talk briefly about, everyone told me I talked too much. So notice I was very quiet for the first 10, it was more like 12 minutes. Can I just talk a little bit about revenues per employee and where we're seeing evidence? Because there's so many people that are saying, well, there was a study done by MIT and they said nobody's making money on AI, which is really dumb. Because if you're hiring fewer employees or you're getting stuff done faster, that expands margins, it improves cash flow, and it goes to the bottom line. That's making money. So I read an analysis by Mark Mahaney from Evercore ISI, great guy, has been in business a long time, and he's very smart. He covers all the internet companies and has his whole career. So he wrote a piece on how the return on AI is accelerating and is evident, really, that you can see it in revenue per employee. So from 2023 to 2025, Google's revenue per employee went up 29%, Microsoft's went up 30%, Amazon 39%, and Meta, Facebook, 74%. And then he calculated EBIT, which is earnings before income taxes, and it's also up per employee. So 41% for Microsoft, 62% for Google, wait for it, 188% for Meta, And then the big mother is Amazon with a 550% improvement in EBIT over the last 2 years. So
Wow.
it's happening, folks. And we're seeing it. Now, Meta laid off a lot of people. Amazon laid off some people. So that's obviously going to improve any metric per employee. But in general, these are not the kind of layoffs we saw in the 70s and 80s. These are, we're laying off 1,000 programmers or, duplicative management positions. So it reinforces everything that we've said for the last 3 years that we've done in our portfolios, which has shown up in the performance of our portfolios, and in particular relative to the benchmark. So I think this is continuing for a long time, and it will allow us to do as that article or the Dallas Fed recently pointed out, thank you for sending it to me, which was the job market is not weakening, it's rebalancing. And I think that that's true. And we're going to be able to do more with less, which is what happened in the 90s. And that's called productivity, my friends. So I'm pretty excited. And we will use any weakness in these stocks to add to holdings.
Yeah, I mean, think about it, Nancy, when we went from, computers, and my dad tells us these stories about putting the cards in. If you don't stack them the right way, then you had to put them in the machine. And this thing couldn't even do what we could do with a simple calculator. No, I'm not even talking like the HPs. Yeah, I mean, phone, that's not a phone. That's a computer that actually makes phone calls sometimes. I don't really, but you think about Microsoft Excel when it first came out in Word. Before that, we had typewriters, we had onion paper, we had whiteout, and you had to have all these people that could type, and now it's just the next evolution, and it's percolating down across the economy. I think we spoke this in one of our prior shows. We talked about the video of that 40-foot agriculture laser that you got your tractor that is GPS enabled. And it's just driving at 3 in the morning when you're sleeping, and it's got this huge panel behind it with lasers and cameras, and it's looking at weeds in your crops and zapping the weeds. No chemicals. No one out there having to do it.
It's awesome. Yeah.
And it's percolating across the whole economy now.
It is. And we're seeing it because we listened to the earnings call. So we're seeing it across sectors. And that's been our investing theme. As you know, Arthur, is old economy companies that are embracing the new technologies, and then the developers or providers of the picks and shovels for those technologies. And we've talked ad nauseum about Walmart being the poster child of an old economy company that's embraced every technology. It's the only consumer staple we own, and it's the best performing consumer staple because of that. But also what you're hearing a lot of is that there's too much concentration in the market. And so I had the team go back and look, and I think I wrote about it this research bulletin and a previous one, but just go back and look at other periods of transformative technology. So think railroads, and then manufacturing and auto manufacturing, and then energy, and then the financials in 2000. And there have always been significant concentrations in the indices and in the economy. So the Dow Jones, I think, was formed as an index in 1896. Before that, in the 1890s, before it was formed, railroads were 60% of the market cap of the economy. And then once the index was put in place, they were 40 to 50 the next decade, and on it goes. So we're not even close to that. The 90s, it was the Four Horsemen. Now we're talking about the Mag 7. So I think it's a pretty exciting time to be living, but also to be an investor.
But this is funny because everybody thinks that, everybody thinks they can do what we do because it's easy, because, you buy some of these stocks and they just run and you're like, oh, I'm a genius. They confuse brains. The bull market is what we say. We have all these great little sayings like I'm sure every industry does. And I think one of the things that we point out with all of these periods in time, Nancy, if you just, bought railroads and held them and closed your eyes and didn't really have an investment theme and an active approach to what you were doing, and you missed the transition, it's really, really painful. And
Right.
Some of these companies that we're talking about now, they're going to disappear, and they're going to get acquired. They're going to acquire other people, and they're going to spin off businesses, or they're going to go out of business because they make bad decisions. And that's what professional investors do is we look at that, we're trying to figure out like what's going to happen, who's going to win this battle. And sometimes they come back and sometimes they go away, like, research in motion. I mean, blackberries, what's a blackberry? Palm Pilot.
Yeah. And you could argue Xerox developed the mouse and then fell asleep, and it was monetized by Apple and Microsoft. And Intel is getting bailed out by the government and by fellow companies, but they just announced their new technology and the stock didn't go up. So I think it's because it's not a very good, it's not the latest technology. And so it's going to be interesting.
Big one to point out, Nancy, that was a big disruptor for a short period of time is what was the Chinese company? DeepSeek, right?
Oh, yes. Yeah.
Have you heard the word DeepSeek since that silly cycle?
No, I was actually on CNBC that day for an hour, and you walk onto the set. I haven't even seen the newspaper, and then this is what we talked about. And what we said was, hey, we're going to, stocks got clobbered. We're going to be buying them because Jevon's principle says that, you're going to need more as technology evolves. And that's what's happened. The hyperscalers have increased their spending. It's been good for the whole technology sector and for some of the related sectors. So, you're 100% right.
Go back for a second. Jevon's principle, what's that?
Paradox, sorry. Okay. I'm going to look it up because I don't want to quote it incorrectly. Let me consult my friend Gronk. I knew that like a month ago, and come back to me.
Okay. And this is why I think we go back to the inflation, some of these other numbers. I think it's going to be harder and harder as this economy starts to shift for the traditional measures to really tell you the information that you think they're telling you. People think inflation is one thing, or you have a metric, and it's like, oh, well, prices, look at eggs. Yeah, but inflation's a capital letter. So when we're talking about macro variables or macro issues of the economy, macroeconomists talk about everything in capital letters. Like when they talk about prices or they talk about quantity, they're not talking about the price of eggs or the quantity of eggs. They're talking about the price of all goods and services in the economy. And they're talking about the quantity of all goods and services. And when you're doing those charts, there's a reason you write a capital P for price, because it's a macro data point. Whereas the price of a widget is lowercase p. Inflation's another one of those macro variables. So it's the full price level. It's your lack of total purchasing power. It's not about whether a TV costs more or less. It's about all prices of goods, services in the economy, and whether you can buy more or less with the same dollar. Yeah. Sorry. No.
Well, it came up right away. I just want to give a commercial for Grok, but it is. I just didn't want to butcher it. It's a paradox that argues that when you get improvements in the efficiency of a resource. So the question was DeepSeek making AI better? And the answer that at least we were being told was yes. It leads to an increase in the overall consumption of that particular item, like AI or technology, rather than a decrease. So it's the opposite of what you would think. And that's why we were confident that many of the hyperscalers were going to continue to invest. We didn't expect them to increase their spending, but they did. We did think, though, that it wasn't going to put NVIDIA out of business. It wasn't going to put Microsoft or Google or Amazon or Oracle out of business. And quite the opposite has happened.
Yeah.
So, all right. Well, then can I just announce our two strategies that you're going to do? Ladies and gentlemen, we decided to build a thematic portfolio, and we're calling it Macro Cycle Opportunities. And we're investing in all the themes that we think, and we're hosting a webinar on this. So if you're not on our distribution, it will be Friday. I don't know what time, but I think 11 Pacific time. But it's all the themes that we think are going to continue to drive this technological revolution. And so it's space and robotics, it's quantum, it's nuclear, and it's AI, and then the materials that are driving these new technologies. Arthur is going to launch an equivalent version with ETFs. And so we launched the MCO, as we call it, with individual securities on 9/30. And now we've been working on it for quite some time. And then Arthur's going to be looking at it a little differently with ETFs. And the only thing I would point out to Arthur's earlier point is that there are speculative names in this portfolio. And as he says, some of them may not be around in a number of years. So the way we built the portfolio is the leaders, which is about 40 to 50% of the portfolio. So the leaders in each theme. So quantum, amazingly, think IBM. They have like 40%, 7% of the quantum contracts. Not a rocket ship performer, but one that we want to own in that particular sector. And then the enablers. So there's a number of the enablers. I've pulled my spreadsheet, but I think I put them on the floor like a doofus. So the enablers and then the speculative names. And the speculative names are going to be 0 to 15%. Occasionally, we'll let them appreciate to 20%, and then the enablers 25 to 30. That way, we can mitigate risk but still participate in the space, and we think it's really exciting. So, anyway, it's a 3 to 5 to 10-year strategy, we believe. So, and then we'll pivot to the next big theme. So, stay tuned.
Yeah. Well, thank you, everybody. I think that's probably enough for our first podcast. We're going to start doing this every week, and just like we did with our live cast. And if anybody has questions that they want us to address, please send them in, and we'll bring stuff up in the show. I think we're going to have a little segment where we can even have the questions read out loud, our responses to it. So things that are important to y'all, all y'all. All y'all.
That's the Nashville coming out, even though he's California native.
I love it here. No income tax. And we'll try to address that on shows in the future too. So please join us again next week when we have our podcast. And this is the Laffer Tengler Take. And I'm Arthur Laffer with my partner,
Nancy Tengler. Thank you.
Take care.